Welcome to vTalkInsight, Risk Sentiment Daily for March 6, 2026. A rapidly escalating Middle East conflict is colliding with an energy shock, forcing equities and rates to reprice risk in real time. Let's start with how overall risk sentiment looks today, and then unpack what is driving both the risk-off tone and the remaining pockets of resilience. Across major assets, overall risk sentiment today leans cautious risk-off. Oil has just logged its biggest one-day rise since 2020. The S&P 500 has slipped, and volatility is elevated, with the VIX trading in the low 20s. That combination points to investors paying up for protection and trimming exposure rather than adding aggressive risk, even as headline indices remain far from capitulation levels. The backdrop is dominated by the Iran-related conflict and its impact on energy flows. Shipping through the Strait of Hormuz has collapsed to a fraction of normal. Refineries and LNG plants in Saudi Arabia and Qatar have been hit, and attacks on tankers and infrastructure are feeding a sustained spike in crude and gas prices. European equities are under pressure, travel and leisure names are lagging, and emerging market sovereign bonds and currencies are seeing stress, all consistent with a classic energy-led risk-off episode. However, this is not a one-way panic. Energy and some AI-related tech names are still attracting flows. Asian equities such as Korea have staged rebounds, and institutional portfolios have not yet seen wholesale de-risking. So the picture is a defensive skew rather than outright capitulation, with markets caught between a severe but still evolving energy shock and pockets of resilience in growth and earnings. The most important bearish driver is the Middle East energy shock and supply risk. Security threats and soaring insurance costs have left the Strait of Hormuz effectively shut, with tanker traffic reportedly down more than 95% from normal levels. That choke point carries a large share of global crude and LNG, so its near closure is already forcing OPEC producers and Asian refiners to reroute cargoes, cut exports, or draw on strategic reserves. At the same time, physical infrastructure is under fire. Drone and missile attacks have damaged major facilities, including a Saudi refinery and a Qatari LNG plant, while oil tankers have been targeted across the Gulf. Efforts to ensure or militarily escort ships face logistical and political hurdles, meaning any large-scale protection regime is unlikely to be in place quickly, which prolongs the period of constrained supply and elevated uncertainty. Macro implications are significant. A sustained $80 oil price is estimated to shave around 0.6 percentage points from global growth, with Europe and emerging Asia especially exposed, and triple-digit crude would raise clear recession risks for some economies. Sector-wise, airlines are being squeezed by surging jet fuel costs and profit warnings, while energy producers outperform in the short run but face questions over how sustainable current price levels and valuations really are if the shock later fades. The second major headwind is energy-driven inflation and rates repricing. Recent jumps in oil, gasoline, and European gas prices are raising concerns that the disinflation trend has stalled and that headline inflation could move higher again. Estimates suggest that if current energy prices stay elevated for a few months, Eurozone inflation could rise by roughly 35 basis points, with similar pressures building in other energy importing regions. Bond markets have reacted quickly. European sovereign yields, from German bonds to Italian debt, have risen since the conflict escalated, and markets have shifted from pricing rate cuts from a European central bank to tentatively assigning some probability to renewed hikes. In the U.S., Treasury yields are climbing despite the geopolitical shock, reflecting a move away from imminent rate cut expectations and a debate that has shifted toward whether policy may even need to tighten again if inflation proves sticky. Policymakers are emphasizing a meeting-by-meeting, data-dependent approach because the growth and inflation effects are highly uncertain, especially for Europe, which faces both higher input costs and weaker demand. For portfolios, the key tension is that higher energy costs can simultaneously pressure growth and keep policy rates elevated, undermining the classic playbook where bonds rally as equities fall and limiting the space for conventional duration hedges to offset equity risk. The third bearish driver is a volatility spike and increasingly fragile risk structures. The VIX curve has inverted by around 4 points, with spot volatility trading at a premium to near-dated futures, a pattern associated with acute short-term stress and hedging demand. Equity markets have seen violent intraday reversals, particularly in Asia, where indices like Korea's have whipsawed as leveraged and consensus positions are unwound. Traditional safety valves are not working cleanly. Gold and the yen have at times failed to offer protection, and U.S. Treasuries are selling off even as equities decline, meaning bonds are not providing their usual hedge. Emerging market currencies are swinging sharply, with oil importers especially vulnerable, and sovereign bonds across parts of the Middle East, Africa, and high-yield Europe have seen outflows as risk appetite retrenches. Elevated volatility is tightening financial conditions and exposing stress points in crowded trades, from AI and crypto-sensitive equity baskets to popular carry trades in Brazil and Central Europe. There are also growing questions about liquidity in private markets, where limited mark-to-market can obscure correlations until redemptions and refinancing pressures force repricing, adding another layer of fragility if the current shock broadens. On the supportive side, resilient U.S. growth and earnings remain a key bullish driver. Recent ISM services and private payroll data have surprised to the upside, reinforcing the picture of an economy that has absorbed past rate hikes and tariff shocks better than many feared. That resilience helps cushion U.S. equities and credit from external shocks, even as energy prices rise and global growth expectations are revised lower elsewhere. Corporate earnings are another anchor. Strong profit growth and positive earnings surprises underpin the view that recent equity dips driven by oil are more about risk premia than a collapse in fundamentals. The U.S. is also in a relatively strong position on energy security, with substantial domestic production buffering the direct hit from disrupted imports, which supports both the equity market and the dollar. From a policy perspective, the current stance is widely seen as appropriate, with no urgent need for immediate action while inflation hovers in the mid-2s to around 3% and long-term expectations remain anchored. That flexibility allows the Federal Reserve to respond if the energy shock either fades or intensifies, and gives investors some confidence that policy will not react in a way that unnecessarily amplifies near-term volatility. Another important bullish force is AI and tech-led growth optimism. Broadcom has projected that its AI chip sales could exceed $100 billion as soon as next year, with an existing backlog above $70 billion, underscoring the scale of demand for advanced semiconductors. Those numbers have driven a strong rally in the stock and reinforced the narrative that hardware exposed to AI remains a powerful earnings engine even in a choppy macro environment. Broadcom is also differentiating itself through custom silicon for major clients, such as bespoke AI accelerators, which supports the idea of a broadening supplier base beyond the most visible names in the sector. More broadly, early adoption of AI is helping companies run leaner operations with existing staff, which can support margins and earnings even if top-line growth moderates. There are, however, important caveats. Regulatory headlines around U.S. chip export controls have already triggered sharp sell-offs in some semiconductor names, and concentrated ownership in AI and crypto-sensitive markets like Korea and Taiwan leaves them vulnerable to de-risking waves. Even so, the structural AI demand story is one of the main reasons why parts of global equities remain bid despite the surge in geopolitical and macro uncertainty. The final bullish driver is ongoing equity dip buying and risk resilience. Despite repeated geopolitical shocks, broad equity and deal activity have held up, with many participants conditioned to look through short-term conflict headlines. Asian markets, including the Korean index, have led rebounds after recent sell-offs, and some view the latest oil-driven pullbacks as another opportunity to re-engage with risk. Technically, recent Middle East-related volatility saw a key equity benchmark sell-off and then quickly recover back above an important support area, which some interpret as a bear trap that flushed out weak hands. Energy has been the top-performing sector over the past several days, and there is a consensus in some quarters that conditions favor a near-term rally, even if the conflict and oil price path remain key swing factors. At the same time, several observers argue that equity markets, especially in Europe and Asia, are underestimating the full downside from a prolonged conflict and sustained energy shock. That tension between dip buying and underpriced tail risk is central to today's setup, and it means the path of both oil prices and the conflict's duration could trigger abrupt shifts in equity risk appetite. To sum up, today's risk backdrop is defined by a severe Middle East energy shock, rising inflation and rate fears, and a notable spike in volatility, offset by resilient U.S. growth, powerful AI-driven earnings stories, and persistent dip buying in equities. The balance between those bearish and bullish forces will likely hinge on how long the Strait of Hormuz disruption lasts, how far oil prices climb, and whether bond markets continue to bear the brunt of inflation anxiety while equities stay relatively optimistic. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.